You've probably heard that investing in the stock market is complicated, but that's actually false. Yes, chart analysis and stock picking can be extremely complicated. However, strategies like that are actually not recommended. In fact, the greatest stock picker of our time, Warren Buffett, has even said himself that most people out there should just own a low-fee S&P 500 index fund. But he even took things a step further by wagering a now famous bet against 5 hedge funds to prove this strategy works. Buffett placed a $1 million bet against these seemingly cutting-edge stock pickers, wagering that a simple S&P 500 index fund would beat every single one of them over a 10-year period. In his 2017 letter to shareholders, Buffett shared the results, and while some of the hedge funds got off to a good start, the S&P 500 beat all of them by a massive margin. During that decade, the S&P 500 returned 125.8%. Meanwhile, the portfolio of hedge funds had returns generated ranging from 2.8% on the low end to 87.7% on the high end. Point being is that you are in the right place and you are following the correct strategy. I'll be showing you exactly how to follow this approach, which smoked the hedge funds by investing in a low-fee Vanguard S&P 500 ETF, just like Buffett recommends. So stick around to the very end, because this video has the rare potential of turning you into a millionaire, and I'll even prove it. For starters, let's define what the S&P 500 is. The Standard & Poor's 500 index is a market value weighted index of the 500 largest publicly traded companies in the United States. Market value weighted simply means the larger a company is in terms of their market capitalization or total market value, the more weight that they carry in the index. So when you invest in the S&P 500, a large portion of your money goes right into stocks like Microsoft, Apple, Nvidia, Amazon, and Meta. FinViz has a visual heat map that shows you this in action. The larger the square is, the more of your money gets allocated there. Now, the S&P 500 was launched in 1957, which predates many of the companies that are included in the index today. To adjust for this, the 500 companies included in the index change over time based on what companies are the most valuable, as well as a few other set criteria. The S&P 500 is the most widely accepted benchmark for tracking the US stock market, and because it has been around for so long, we have decades of historical performance to look back on. According to NerdWallet, the S&P 500 index has returned about 10% on average per year, assuming you are reinvesting dividends. In addition to returns being generated from the share price of the stocks going up over time, you also have the secondary income stream of dividends being earned. This is a way that well-established companies that might not be growing very fast anymore will share a portion of their profits with the shareholders in order to keep them sticking around. Later on, I'm going to be showing you exactly how to enable dividend reinvestment within your brokerage platform to make sure you're maximizing your return potential. So why do people invest in the S&P 500? Well, the very reason for investing in the first place is to protect your buying power from inflation, as well as to grow the value of your money over time. Inflation has historically been around 2% annually, but since the pandemic and the stimulus money that entered the economy, inflation has been at elevated levels. Now, this makes investing all the more important because idle cash is losing purchasing power at a faster rate than it has in the last 40 years or so. Now, in addition, the S&P 500 gives you broad diversification across the entire US economy. Let's revisit that FinViz heat map that I showed you earlier. When you invest in an index like the S&P 500, your money is spread out across all of these different sectors and industries. This gives you exposure to all of the different segments of the United States economy, and even if one particular company or segment takes a nosedive, the rest of what you own will help you offset that. You also have the benefit with this strategy of following a set it and forget it approach, where you can fully automate everything and then spend your time doing whatever you would like to. And get this, the S&P 500 has the potential of turning you into a millionaire. Let me prove it to you now. What we're looking at here is a compound interest calculator, and this shows us how the value of your money can grow over time through investment. I just did a full video on compound interest explained for beginners, so I'll put a card in the corner, but let me go ahead and give you a simple explanation now. The rate at which your money grows is going to accelerate over time because when you earn compound interest through something like the stock market, the returns that are generated generated are also able to earn future returns, and the dividends that are earned, assuming you reinvest them, are able to earn future dividends themselves. So let's say you start off here with a $0 initial investment and you're contributing $500 per month into the S&P 500, and we're assuming you're going to experience that average 10% annualized return from the S&P 500. After 10 years of following this strategy, your portfolio would grow to a value of just under $100,000. Now, in terms of your total contributions, you would have contributed $60,000 and you would have about $35,000 in capital gains. Right now, this chart is really nothing too exciting. I mean, you have had a little bit of growth there, but just wait and see what happens as we push the timeline out further and further. We're now going to adjust this and look at the 20-year mark, and most people would think that this number would be roughly double, or about 200,000, but this is where you can see the magic of compound interest starting to take place. If we click on the calculate button, we can see now the portfolio has grown to almost $350,000, which is a heck of a lot more than double what we were at prior. If we take a look here at the contributions, you've contributed $120,000, and now you've had about $210,000 or $220,000 in terms of your gains from the market. And if you take a look at the red line, you can see where it's beginning to accelerate at a faster and faster rate. And every single year, you're earning more in returns from the market. And this has less and less to do with the amount you're contributing and more to do with the momentum that has been established through these decades of investing. At this point, though, I want to show you how long it would take you to become a millionaire. And I did this in advance, so I already know. And that answer is just 31 years. If we push out to the 31-year mark, and click on calculate, you would now have 1.09 million in your investment account, and that red line is just continuing to accelerate at a faster and faster growth rate. Now, in terms of your contributions, you've contributed about 186,000, and in terms of your investment gains, you've made a little over 900,000 from the stock market by investing over the long haul. That is the magic of compound interest, and this is something that you can do yourself through a strategy like S&P 500 index fund investing. Now I'm going to show you how to put all of this into action using the commission-free stock trading app Robinhood, and if you want to get a free stock in the process worth up to $200, be sure to use my affiliate link in the description below. The very first thing you're going to want to do is visit ryanoscribner.com/Robinhood. It brings you to this screen where it mentions that you will be able to get a free stock and actually pick that stock from a list of leading American companies. So what you'll end up getting here is a fractional share, and you'll be able to pick which particular company you want that to be a fractional share of. All you're going to do here is enter your name as well as your email and password and click on continue, and then you're going to download Robinhood from the App Store. Now, I already have an account, so we're going to jump into that now, but if you're looking for a full tutorial on how to get started with Robinhood, I will put my Robinhood Investing for Beginners video in the corner. That way you can watch that and get a full overview on getting up and running with this stock trading app. Here we are inside of my Robinhood app, and right now I have a balance of $0, so the very first thing I need to do is deposit some money. So I'm going to click here on buying power, I'm going to click on deposit funds, and I'm going to take $20 and deposit it into my Robinhood account. You're going to be able to invest using fractional shares, and that's really cool because you can invest in $1 increments into stocks and ETFs, which makes the barriers to investing really, really low here. So we're going to click on the review button, and then once I'm all set, I'm going to click on transfer $20, and then once I click on the continue button, we can see we have an instant deposit available. So one of the things I like about Robinhood is they give you instant access to your funds even before they clear from the bank, so that means that you can invest right away using this app. So now we have $20 of buying power in the investing app. What we're going to do is click on the search button in the top right, and we're going to search for the Vanguard S&P 500 ETF, and the symbol for that is VOO. Now you can click here and see what the S&P 500 has done over time, but the main thing to understand with this is if you look over the long run, the S&P 500 continues to go up and make people money even when you do have these dips in the market. I'm going to be showing you how to follow a strategy known as dollar cost averaging later, where you have recurring money going into the market and you're buying at routine intervals, and that means that you'd be buying some when the market is up, you'd also be buying it as it goes down, and all all across the timeline here, meaning that you're paying the market average for those shares over time. What we're going to do now is just scroll down and I'll show you some more information here about this particular ETF, and you can get a really nice visual here that shows you what sectors your money is going into. Now, because the most valuable companies in today's modern economy are tech-based, 30% of your money goes into the technology sector. Second to that, we have financials and then healthcare, both at around 12%. And then we have consumer cyclical, etc., etc. In the past, you would have seen more of your money going into industrials or these other segments of the economy that used to be the most valuable companies. But as that changes over time, because this is a market value weighted index, the allocations are going to change. And in terms of the top holdings, if you click here, you can see what stocks the majority of your money is going into, and this always blows my mind. When you invest into this fund, let's say you put $1 into this fund, for example, 7 cents of that is going to go right into Microsoft, about 5.6 cents goes into Apple, about 5 cents goes right into Nvidia, and then you have Amazon, Meta, Alphabet Class A, Berkshire, the other class of Alphabet, which is Google's parent company, Eli Lilly, and then Broadcom. A lot of your money goes right into the top 5 biggest names because of how dominant those companies have become in today's economy. So a lot of people think the S&P 500 is like this boring investment, but in fact, a lot of your money is going into the most innovative companies in the US economy. But what we're going to do now is actually purchase some fractional shares of this ETF. So we're going to click on the trade button here, and then we're going to click on buy. And right now it's set to purchase shares. So if I wanted to buy one whole share of this, it would be about $458, which obviously I don't have. But if you click up here, you can buy in dollars and buy in $1 increments. So if you wanted to put literally just $1 into the S&P 500, you could do that with Robinhood. But in this case, we're going to do $20 and invest this into the S&P 500. What we're going to do from here is click on the review button, and it's going to purchase 0.04365 shares of VOO. And when we're all set, we're going to swipe up to submit that order. And just like that, we invested in a fractional share of the S&P 500 ETF. And you can see that overall, so far, there's been a return of 0.05%. So the price is always going to be fluctuating. And if you want to take advantage of that strategy of dollar cost averaging, you can set up a recurring investment here, and you could invest every day and the market's open. You could invest every week, every 2 weeks, or every month, and have a recurring contribution going into the S&P 500 ETF. And this would be just like what I showed you in the compound interest calculator of investing $500 per month. So if you want to fully automate this strategy, you can do this right here by investing on a recurring schedule. And the very last thing I want to show you now is how to enable dividend reinvestment to make sure you're maximizing your returns. In order to do that, you're going to click on the person icon here. You're going to click on the 3 dots in the top left, and then you're going to click on investing. Within this, you can scroll down and you can see the section here about dividend reinvestment. It's currently disabled, but if I click on enable dividend reinvestment, we're going to click on continue, and then it tells us how it works. So basically, it's going to automatically reinvest any cash dividends on the next market day back into whatever the asset is that issued that dividend. And you can also pause this at any time. We're going to click on the continue button. I'm going to click on review here and agree to these terms. And just like that, we are now enrolled in DRIP, or a dividend reinvestment program. As I earn dividends from the S&P 500 ETF, they're going to be reinvested back into more fractional shares, allowing me to maximize my return potential. What I just showed you is the strategy of dollar cost averaging into fractional shares of VOO, which is the Vanguard S&P 500 ETF. But now I want to take you under the hood here and show you more about this particular ETF. The first thing I want to explain is, what is an ETF? Well, that stands for an exchange traded fund, and this is simply an index fund that's split up into individual shares, and then those shares trade on an exchange just like an individual stock. This makes things a lot more flexible because you can buy individual shares of this ETF instead of investing directly into an index fund, which could have a higher minimum investment. And using something like Robinhood and their fractional shares, you can actually buy a fraction of one of those individual shares in $1 increments. That means you can literally take $1 and put it into the S&P 500 and be completely diversified across the 500 largest publicly traded US companies through one single investment. investment. Now, every fund out there has an expense ratio associated with it, and this fee is used to pay the fund managers as well as other administrative costs. The good thing about Vanguard is they have some of the most competitive fees in the entire investment industry, and for VOO, the expense ratio comes in at 0.03% compared to an industry average of 0.79%. That means if you invested $10,000 into VOO, you're going to pay $3 of annual fees to Vanguard for basically managing that fund on your behalf. Now, you don't have to pay this fee separately or anything like that. It actually comes right out of the fund itself, but that is a very low fee compared to what you will see across the industry. As far as the dividend yield goes, this ETF pays a yield of 1.3% on average over the last 30 days, and that's because the yield is going to fluctuate based on the share price of the particular ETF. Now, if you want to learn more about Vanguard index funds specifically, I also have a full video on that, which I'll put in the corner, and you can check that out to learn more about Vanguard and what they have to offer. But now we're going to talk about an aspect of investing that most people like to try to avoid entirely, but you have to plan for this from the beginning, and that is investment taxes. The type of investment account that you use has a huge impact on the amount of money that you pay in taxes. If you invest using a taxable brokerage account, you'll most likely end up paying long-term capital gains tax rate on your investment gains, and that caps out at 20% on a federal level, and there also could be additional state taxes owed. In the previous example, we looked at investing $500 a month for 31 years, earning the average 10% return from the S&P 500 and becoming a millionaire in the process. But here's the crazy part. As we mentioned, your investment account would be worth about $1.09 million, but the amount that you contributed yourself is only $186,000. That means if you cashed out of the market all at once and simply wanted to take your $1 million and do something else with it, you would have roughly $905,000 in capital gains, and at just a 20% tax rate on the federal level, that would be $181,000 owed in taxes. Now, in addition, you would also be required to pay taxes on your earned dividends, even if you're just reinvesting them. If you were earning a 1.3% yield on a $1 million account, that would be $13,000 per year in dividends that are earned. The tax rate for this can also be as high as 20% for qualified dividends, and keep in mind, there could also be additional state taxes. But even if you're just paying a 20% tax on that, that's $2,600 per year that you would owe in taxes on your dividends earned. So you would have to pay those dividend taxes owed out of pocket, or take that money out of your portfolio, which is going to have a hindrance on your total investment returns. But if you invest through a retirement account, specifically a Roth IRA, you can shelter yourself from all of these taxes. Now, I'm going to be doing a full video on the Roth IRA very soon, and if you want to be notified when that comes out, make sure you subscribe and hit the bell for all notifications. With a Roth IRA, you're contributing your post-tax dollars, which means there's no upfront tax benefit like there is with something like a 401k. Instead, all of the benefits that you experience are at the end. And if you don't touch the earnings from the account before the age of 59 and a half, as well as meeting a few other basic requirements, both your capital gains and your earned dividends are 100% tax-free. So if you're investing for the long run, possibly even for retirement, you should definitely look into the Roth IRA, and Robinhood also offers this type of investment account within their suite of services. Don't forget to click the link in my description as well if you want to get that free stock when you sign up, worth up to $200. The last thing I want to cover here is a few pitfalls to avoid when following this strategy of investing into the S&P 500. First of all, lump sum investing or dropping a ton of money into the market at once is not recommended. The stock market has boom and bust cycles called bull markets and bear markets, and during the worst times, the stock market has dropped north of 50% in these bear markets. If you just so happen to put all of your money into the market at the very top, you could be in for a massive paper loss, and this can be extremely frustrating as well as unnerving. While we're on the topic of stock market crashes, you also need to avoid the pitfall of overreacting to market volatility and possibly selling out of the market. Even with the massive drops that we have seen in the S&P 500 in the past, the average annualized return has still been about 10% per year, and in modern history, it's actually been a little bit higher. If anything, during the big drops, you'd actually want to buy more shares because you're getting a discount on them and you're able to buy more shares with the same amount of invested capital. That's why dollar cost averaging is really the best strategy to follow here, because whether the market is going up or it's going down, you're just investing the same amount of money into the market at a routine interval and paying the market average price for those shares over time. The last pitfall to avoid here is ignoring investment fees. We've already covered the low fees associated with the Vanguard S&P 500 ETF, so you're all set with that, assuming you follow that strategy. But if you happen to invest in something else, you should really look into the fees associated with that investment before you commit to that long term. And just like that, you are now an expert on passive long-term investing. This is the only strategy that works for everyone, and you can sit back and relax while other people out there are stressed out about stock picking or complicated strategies. Now, as you get older and closer to retirement, you may want to allocate some of your money into bonds to eliminate some of that downside risk associated with the stock market, and you should talk with a financial advisor about the specifics there. Don't forget to subscribe, hit the bell, and turn on all notifications. That way you're alerted as soon as my Roth IRA for Beginners video comes out. You can click below to watch my video on Robinhood investing for beginners, and I hope to see you there.